Hi, my name is Mark DiPietro-Antonio, and I'm a member of the Schneider Construction Industry Group. At Schneider Downs, we provide audit, tax, advisory, and business transformation services to our clients. We work with small, medium, and large contractors at Schneider Downs. And today we're going to have a short video on the tax implications of the One Big Beautiful Bill on the construction industry. So we're going to answer two questions today. What are the provisions that are impactful to the construction industry? And what should our construction clients be doing now to react or plan for the bill? So without a doubt, the most significant provision of the bill to our client base is the extension of the 199A deduction. And what this deduction does, it allows for a 20% deduction for qualified business income that's passed through to clients on a K-1 from a partnership or an S corporation. So if a partnership or S corporation passes through $10 million of taxable income to the shareholder, that shareholder is eligible for a $2 million deduction on their personal tax return. So that provision was scheduled to phase out or expire at the end of 2025. Now it's permanent and is available to clients going forward. The next provision that was impactful to our clients, two depreciation provisions. Bonus depreciation, which was scheduled to be 40% in the 2025 tax year, has now been reinstated to 100% for assets acquired after January 29th. And 179 depreciation was increased to $2.5 million for the 2025 tax year. The next provision that is very impactful in our client base, for clients that are claiming the R&D credit, those clients were actually required to capitalize and amortize their research and development costs beginning in the 2022 tax year. What the bill does is it says that clients can now take those unamortized costs for the 22, 23, and 24 tax year and deduct those costs in 2025, or make an election to deduct 50% in 2025 and 50% in 2026. Small clients, small taxpayers actually have a more beneficial role out there available to them. They can go back and amend tax returns for the 22 and 23 years to get those tax dollars paid in those tax years even quicker. Two reporting issues for our clients generated by the bill is that overtime is now required to be reported on a W-2. Those employees will now be able to take a deduction on their personal tax return of $12,500 for a single person, or $25,000 for a taxpayer filing a joint return on their individual income tax return. So that helps to fulfill the campaign promise of no tax on overtime. The second reporting issue is that the 1099 reporting requirement at threshold has been increased from the $600 annual payment limitation or threshold to $2,000. So if a contractor has a subcontractor working for them, they do not have to issue a 1099 until those payments exceed $2,000 per year. And that $2,000 will now be indexed for inflation. The next provision that applies specifically to contractors, the ability to use the percentage of completion method of accounting for residential contractors has been waived. So those contractors doing residential contracts can now use their exempt method of accounting to account for those contracts. So if they're building dormitories, assisted living, apartments, or even jails, they can use their exempt method of accounting and avoid using the percentage of completion method. So if their exempt method is cash or completed contract, they can use that method of accounting for those contracts. The next provision, sort of a depreciation rule, another depreciation rule, is the ability for taxpayers to expense the cost of real property if that property qualifies as what's defined as qualified production property. So there's a lot of rules that go behind this. Two of the major rules is that building has to be started after January 29th, 2025, and before January 1st, 2029, and that building has to be placed in service before January 1st, 2031. So lots of rules behind that one. If you're looking to take advantage of that one, taxpayers definitely need to do their homework on that one. The next provision related to contractors is that the 179D deduction is now gone. The bill gets rid of that for buildings started after June 30th, 2026. So just a little bit of background behind 179D. Contractors that were building energy efficient buildings could be allocated deductions as long as they were building those buildings for government agencies or nonprofit groups. So again, that deduction is gone for buildings started after June 30th, 2026. The last provision that we're definitely making sure our clients are aware of is that the estate tax exemption has been increased to $15 million per taxpayer. So $30 million for a joint, for a husband and wife. That rule or those amounts are effective for the 2026 tax year. And those amounts were scheduled to decrease to the pre-2018 amounts, which were approximately $6 million. So the last provision to mention is that $15 million will be indexed for inflation. So again, these are just some high-level concepts that we're talking to our clients about. There's definitely more information on our website, on our resources pages of our website. So we encourage you to go there for more information. And if you'd like to contact me directly, my contact information is located on the screen. Thank you very much.